The intertwining of politics and cryptocurrency is becoming increasingly complex as the Trump administration engages in discussions with Binance, the world's largest cryptocurrency exchange, following the exchange's recent guilty plea in a high-profile case. This development raises significant questions about the future trajectory of digital assets in the US and globally, especially as the administration positions itself as a proponent of crypto legislation. Binance CEO Richard Teng expressed optimism regarding the potential impacts of Trump's policies on the cryptocurrency landscape during a panel at the CONVERGE live event in Singapore. He noted that the shift from regulatory hostility to a more accommodating stance represents a significant turning point for the industry. We have moved from a period where there's big regulatory uncertainty and in many senses some regulatory hostility towards the industry, to one where the largest economy in the world said, "We want to embrace crypto," Teng stated. This sentiment is echoed by industry leaders who believe that institutional and retail adoption of cryptocurrencies will gain momentum under Trump's leadership. This optimism comes on the heels of Trump's recent executive order to establish a strategic reserve of cryptocurrencies leveraging digital assets seized in criminal and civil forfeiture cases. The reserve, which reportedly includes Bitcoin, Ether, XRP, Solana's SOL token, and Cardano's ADA, is seen as a landmark move that could prompt other governments to consider similar strategies. Teng described the U.S. crypto reserve as a fundamental shift, stating, "The messaging is that the largest government and the biggest capital market in the world is now holding Bitcoin as part of the reserve." This could catalyze a broader acceptance of digital currencies among global regulators. However, the optimism surrounding Trump's crypto-friendly policies is juxtaposed with ongoing market volatility. Bitcoin prices have recently dipped below $80,000, contributing to a staggering $1 trillion loss in the crypto market over the past month. Concerns regarding Trump's trade policies and their potential inflationary effects have dampened investor enthusiasm, overshadowing the positive narrative emerging from the administration's crypto initiatives. Larry Fink, CEO of BlackRock, cautioned that a resurgence of inflation could complicate the Federal Reserve's monetary policies, thereby impacting the crypto market further. As the Biden administration previously adopted a more stringent regulatory approach characterized by what some have termed Operation Choke Point 2.0, the current administration's stance marks a notable departure. Teng noted that the previous environment of regulatory enforcement created significant barriers for crypto companies. With Trump's administration now filling key roles with crypto-friendly figures, including the appointment of venture capitalist David Sacks as the White House artificial intelligence and crypto czar, the groundwork is being laid for a more supportive ecosystem. Despite these developments, market analysts remain cautious. The recent downturn in crypto prices reflects broader economic anxieties, including recession fears and persistent inflation, which have left investors skittish. Goldman Sachs economists recently increased their recession probability forecast, attributing it to the uncertainties surrounding Trump's economic policies. As the Federal Reserve weighs its options amid mixed signals from the economy, the crypto market finds itself in a precarious position. As the dust settles from these political and economic upheavals, the cryptocurrency sector is poised for a pivotal moment. The implications of Trump's policies, combined with the market's reaction to macroeconomic factors, will likely shape the future landscape of digital assets. The coming months will be critical for understanding whether the administration's pro-crypto agenda can translate into sustained market confidence or whether the volatility will continue to dominate the narrative. Investors and industry stakeholders alike will be looking for clearer signals and supportive measures from both the White House and financial regulators as they navigate this uncharted territory. In a startling turn of events for the cryptocurrency market, Bitcoin's price has plummeted below $80,000, contributing to an overall market decline of $1 trillion within a month. This sharp decline has raised alarms among investors and industry leaders, prompting heightened scrutiny of economic policies and their potential impacts on inflation and market stability. Among those expressing concern is Larry Fink, CEO of BlackRock, the world's largest asset manager. who recently issued a grave warning regarding the implications of U.S. President Donald Trump's trade policies. In remarks made at the CERAWeek conference, Fink suggested that a rise in nationalism evident in Trump's administration could fuel inflation. He articulated this view stating, "If we all are becoming a little more nationalistic, and I'm not saying that's a bad thing, it does resonate with me, that it's going to have elevated inflation." His comments come at a time when the Federal Reserve's strategies to combat inflation are already under scrutiny. Despite recent data showing a decrease in U.S. inflation rates to 2.8% in February, fears linger that Trump's aggressive tariff policies could complicate the Fed's ability to lower interest rates effectively. The volatility in the crypto market is further exacerbated by external economic pressures, as many analysts predict a potential recession. Goldman Sachs has raised the likelihood of a recession within the next year from 15% to 20%, attributing this shift largely to the current economic climate surrounding Trump's policies. Additionally, Yardeni Research has increased its recession odds to 35%, reflecting the pervasive uncertainty in the market. The mixed signals from the economic landscape have left investors grappling for clarity. Yue Yang, chief economist at Bitmining, pointed out that while the lower-than-expected consumer price index (CPI) could suggest a more favorable environment for interest rate cuts, the overarching fear driven by tariffs and market instability complicates the outlook for both traditional and cryptocurrency markets. Weeks of market fear require more than a single good print to regain confidence, Yang noted. As traders navigate this complex landscape, many are resorting to hedging strategies to mitigate risks associated with increased volatility. Sean Dawson, head of research at decentralized options trading platform Derive.xyz, remarked on the challenging environment, stating, "This market downturn is largely driven by broader economic concerns, including fears of a U.S. recession and persistent inflation." He emphasized the importance of the coming weeks in assessing how these economic factors will influence digital asset prices. In light of this turbulent backdrop, cryptocurrency exchanges are adapting. Bexback, a cryptocurrency derivatives platform, has launched initiatives aimed at attracting traders looking to capitalize on market fluctuations. By offering up to 100x leverage and significant bonuses for new users, Bexback positions itself as a potentially lucrative option for those willing to navigate the high-stakes environment of crypto futures trading. As the market continues to grapple with these profound challenges, the future of cryptocurrency remains uncertain. The interplay between economic policy, inflationary pressures, and investor sentiment will ultimately dictate the trajectory of Bitcoin and other digital assets. Investors are left to wonder whether the current downturn is merely a phase in a cyclical market or the beginning of a more prolonged struggle for stability in the crypto space. The coming months will be critical in revealing how these dynamics unfold and whether the cryptocurrency market can regain its footing amidst growing economic concerns. In a rapidly evolving landscape where cryptocurrencies are gaining both traction and scrutiny, the Trump family's foray into the crypto space has sparked significant ethical concerns and market fluctuations. Following Donald Trump's inauguration, the value of crypto tokens associated with him and First Lady Melania Trump has seen dramatic declines, raising alarms about potential conflicts of interest and the implications of political figures engaging in digital asset investments. Shortly after Trump assumed office on January 20, 2025, the official Trump token plummeted over 20%, dropping from a high of $74.59 to approximately $38 within a 24-hour period. Similarly, the Melania meme token suffered a significant loss, more than halving in value. These declines coincide with a slight downturn in Bitcoin, which fell nearly 1% to around $102,853. Despite these setbacks, the initial surge in value of these tokens prior to Trump's inauguration was attributed to his vocal support for the cryptocurrency sector, promising to position the U.S. as the crypto capital of the planet during a conference in Nashville last July. The implications of high-profile figures like Trump engaging in cryptocurrency ventures extend beyond mere market fluctuations. Reports indicate that a representative from the Trump family has held discussions to acquire a stake in Binance's U.S. operations through World Liberty Financial, a Trump-backed crypto project. The negotiations reportedly began last year when Binance reached out to Trump's allies in an effort to restore its U.S. services, which had suffered under regulatory pressures from the previous administration. This news has not only buoyed Binance's native cryptocurrency BNB, which saw a 5% increase following the reports, but also raised ethical questions regarding the intersection of politics and business in the cryptocurrency realm. Former SEC Chair Gary Gensler's resignation has also fueled speculation about a potential shift in regulatory stances towards cryptocurrencies. Gensler had been perceived as a roadblock for crypto advocates, and with his departure there are hopes that the current administration might adopt a more lenient approach that could benefit entities like Binance. However, Trump has yet to issue any formal executive actions prioritizing cryptocurrency, despite earlier reports suggesting such intentions. The Trump family's crypto ventures have ignited discussions about the ethics of public officials engaging in financial markets, especially in sectors that are still grappling with regulatory clarity. House Democrats have already proposed legislation aimed at banning memecoins issued by public officials, signaling a potential pushback against perceived conflicts of interest. As the cryptocurrency market continues to grapple with volatility, the Trump family's involvement in this space will likely remain a focal point of debate. With ongoing discussions about the future of cryptocurrency regulation in the U.S. and Trump's unique position as a figurehead in the crypto community, the coming months could see further developments that shape both the political landscape and the digital asset market. As stakeholders in the crypto industry watch closely, the outcomes of these discussions may redefine the relationship between politics and digital finance, potentially transforming America's approach to cryptocurrencies for years to come. As the cryptocurrency market grapples with significant volatility, Ethereum's prospects emerge as a focal point for analysts and investors alike. Recent insights from K33 Research suggest that the anticipated staking improvements on Ethereum could serve as a stronger catalyst for price appreciation than the much-discussed Pectra upgrade. This perspective comes at a time when the broader crypto market is feeling the weight of economic uncertainty marked by fears of inflation and a potential recession. The price of Ethereum, or ETH, has been under pressure, experiencing a decline of approximately 13% over the past week. As of March 11, ETH dropped to around $1,875, a significant dip that reflects a broader trend of investors moving towards more stable fixed income assets amid rising geopolitical tensions and economic instability. The rapid sell-off in the crypto market has resulted in a staggering $1 trillion loss in value, a situation exacerbated by external factors such as the US-Canada trade disputes and inflationary pressures stemming from recent economic policies. Larry Fink, the CEO of BlackRock, has voiced concerns that inflation may resurface in 2025, warning that rising nationalism in economic policy could lead to elevated inflation levels. "I think if we all are becoming a little more nationalistic, it's going to have elevated inflation," Fink stated during a recent conference. This sentiment resonates deeply within the cryptocurrency space, where the interplay between macroeconomic conditions and digital asset prices is becoming increasingly pronounced. Despite the current bearish sentiment, analysts posit that Ethereum is uniquely positioned to recover. K33 Research emphasizes that Ethereum's staking mechanism could significantly enhance demand for ETH, especially as more investors seek to earn yields from their holdings. This could potentially drive ETH prices beyond previous highs, contingent on a rebound in market confidence and a stabilization of economic conditions. Recent data indicates that while Ethereum's price has fallen dramatically, trading around 60% below its all-time high of $4,868 set in November 2021, its underlying metrics are showing signs of resilience. The total value locked TVL in Ethereum's ecosystem has seen a notable uptick, reaching its highest level since July 2022. This growth is attributed to the increasing popularity of decentralized finance DeFi applications and liquid staking, which have collectively contributed to Ethereum's standing as the second most popular choice for institutional investors. Moreover, the Ethereum Layer 2 networks have been experiencing notable growth, with transaction costs significantly reduced compared to peak levels in late 2021. This enhanced efficiency is likely to attract more users and developers back to the Ethereum network, setting the stage for potential price recovery. Though the immediate outlook for Ethereum remains clouded by broader economic fears, the ongoing developments in staking in the Layer 2 ecosystem could pave the way for a resurgence in ETH's price. As the market waits for clearer signals from both the Federal Reserve and the geopolitical landscape, Ethereum's ability to navigate these challenges will be crucial. Investors and analysts alike are keenly observing the situation, anticipating that a stabilization in macroeconomic conditions could usher in a new era of growth for Ethereum and the broader cryptocurrency market. In a significant development for the cryptocurrency market, Alameda Research has recently unlocked $23 million worth of Solana SOL as part of its ongoing efforts to manage creditor debts following the collapse of FTX. This move has sent ripples through the crypto community, raising questions about market stability and the future trajectory of Solana, which has faced its own challenges amid a broader downturn in the cryptocurrency landscape. Alameda's decision to unlock such a substantial amount of Solana comes at a time when the market is grappling with volatility. This is not just a liquidity maneuver, it represents a strategic response to ongoing financial pressures faced by the firm. As Alameda seeks to settle outstanding debts, the implications of this release could impact Solana's price dynamics significantly. The decision to liquidate assets during a turbulent market phase has historically led to price fluctuations, and analysts are closely monitoring the situation. While unlocking these assets may provide immediate liquidity, it could also exacerbate downward pressure on Solana's price if the market perceives this as a sign of further instability, said a crypto market analyst. The sentiment among investors is decidedly cautious, with many fearing that Alameda's actions could signal more extensive issues within the crypto ecosystem, particularly for altcoins like Solana that have experienced sharp declines in value recently. Solana, once celebrated for its high throughput and low transaction costs, has faced a series of setbacks, leading to speculation about its long-term viability in the competitive landscape filled with emerging blockchain technologies. As interest shifts, some experts suggest that investors may be looking for safer havens, particularly in light of the continuous outflows from Bitcoin ETFs, which have compounded the uncertainty in the market. Moreover, the broader implications of Alameda's move extend beyond Solana. The cryptocurrency market is still reeling from the fallout of FTX's collapse, and the unlocking of assets can be seen as a microcosm of larger systemic challenges. The intersection of these events raises fundamental questions about trust and liquidity in a space characterized by rapid innovation but also heightened risk. As March progresses, the market will be watching closely how these developments unfold. The potential for further price dumps in Solana and other cryptocurrencies remains a pressing concern, with experts suggesting that the volatility may not yet be over. As Alameda navigates its financial obligations, the focus will likely shift to how other major players in the crypto space respond to these challenges. In conclusion, the unlocking of $23 million in Solana by Alameda Research marks a pivotal moment for both the firm and the broader cryptocurrency market. As stakeholders assess the ramifications of this decision, the future of Solana and its place within the crypto ecosystem remains uncertain. Investors will be keenly observing how market dynamics evolve in response to these developments, particularly in the face of ongoing volatility and the looming specter of liquidity crises.